back. Well, today it's the curtain raiser to Motilal Oswal's 14th annual Global Investor Conference. Our colleagues Latha Venkatesh and Nimesh Shah are with the entire top team at Motilal Oswal to get a sense of what's lined up this year. So let's go across to them.
We have with us the brains trust of Motilal Oswal. And why? Because this is the curtain raiser to the 14th annual Global Investor Conference of Motilal Oswal, often a much-watched event. And I have with me, as I said, the brains trust Gautam Duggad, Navin Agarwal and Rajat Rajgarhia. Gentlemen, thank you very much. Thanks especially from me and Nimesh for giving us some insight into what you are expecting from the conference. But before we get to the conference, day after day, we at CNBC TV 18 are very happy to announce that the Nifty is at new highs. Just a few days back, 11,500 scaled, now 11,600 scaled. So let me start over there, Rajat. If we are at this level, I saw your earnings forecast. Your Nifty earnings forecast is a 21% rise perhaps in the current, or a 20% rise in the current year to 547. And next year you are expecting a further 26% rise to about 688. But is not all that in the price? Even now the FY19 EPS, Nifty EPS, Nifty would be trading at some 21 times. Are we not richly valued?
So I think there are two ways to look at this. First, if you look at our earnings, we have been actually growing at a rate of about 15 to 16% for the last many quarters. But these numbers get distorted because of a couple of corporate lenders and adjustments from a couple of PSUs, because of which the reported growth sometimes looks as low as 5 to 7, yes, and the forward numbers looks as high as 20 to 25. But more importantly, the underlying growth rate has reverted back to about 15 to 16%. That's a welcome sign, right? Secondly, I think the markets are right now partly reflecting the optimism that it sees from the recovery in this earnings cycle. You may look at markets at its all-time high, but aren't they what they are supposed to do? Because as a country, if every year your GDP keeps growing, makes a new high, if your earnings growth keeps growing at whatever rate, but makes a new high, so the markets will just follow some of these matrices with its own share of volatility, right? So I think when you look at forward multiples, the markets may look at above the long-term average multiples, yes, but the earnings growth cycle is what it is more excited about right now. Okay. And as we have seen the disappointments in the last 7-8 years of down cycle, we may be up for surprises in this up cycle also. Okay,
I just want to persist with you, Gautam, on this point. See, it's your report I'm reading, and you are saying that Nifty is trading at a forward P of 18.8 times, and this is at a 21% premium to its long period average. The Nifty price to book is at 2.8 times, and that is 8% premium to long-term average. While it has every right to be at new highs, does it have a right to be at this high highs?
So there are two ways to look at it. When you look at averages, there are always some distortions. Look at Nifty's composition, how it has changed in the last 7-8 years. You used to have telecom, capital goods, oil and gas at 8 to 10% weightages in Nifty those days.
Yes.
Today, you have 80% of the index comprised of private banks, financials, consumption, auto, and IT, right? Now, these are sectors which always trade at a higher P than the cyclicals, because they have a higher ROE and slightly more structural trajectory to their growth. So while from an academic viewpoint, you can always compare the averages of today's P versus 10-year averages, given the way the Nifty composition has changed in the last 10 years, those averages are not as relevant today as they may be 5-6 years back. That is point number one. Point number two is, when you are at an inflection of earnings, see, today I am far more confident on earnings recovery at any given point of time in the last 3 years than I was. If you look at the commentaries of corporate lenders, which have been the biggest disappointment, by the way, if you look at Nifty earnings growth itself for last 3 years, excluding these 3 banks, so you are still looking at 47 Nifty companies put together. The earnings growth was 10% in FY16, 17% in FY17, 10% again in FY18, and we're projecting it to be 17 and 18%. So the numbers 21, 26, while they look disproportionately high, they are bumped up because of the extremely low base of these three banks and of course Tata Motors also. So market will obviously precede the earnings up move, and that is what we are seeing. You've seen the rally extend after the last quarterly result season got over despite so many worries on the global front, Turkey, currency, crude oil, global trade war concerns. So market is climbing a wall of worry because it is forcing an earnings recovery in a lot of sectors.
Okay. Well, from macros to micros then.
Okay. If I can add to Gautam's point, you are looking at a P multiple of 18.8 times, which is a 21% premium, right? But if you look at what is P? P is market price divided by profits, right?
Yes.
The profits in FY18 for the Indian corporate sector is at 3.6% of the GDP. Over the last 15 years, this number has been over 5%. And at the peak, this was at 7.8%. So the profit base, because of the way corporate lenders have behaved, because of the way pharma sector has behaved, capital goods sector has behaved, and sector after sector has behaved, is at a 15-year low.
Okay.
At a 15-year low, if you look at the market cap to GDP now, we are trading at about 80%. The market cap of all companies in India is 157 trillion, which is 80% of the GDP of India, which is where it has been for the last 15 years. And the peak of market cap to GDP for India is 150%. So we are half of that peak. Just gives you a context of, whether we are richly valued in the context of normalized earnings. You're looking at reported earnings just for 1 year. If you were to normalize the margins or the corporate profit to GDP, then the valuations may look less richer than the 21% premium that you alluded to.
Fair point. That's extremely well argued, but now we want to go from averages to specifics.
Correct. So, before I get into specifics into individual sectors as well as what you are going to present at the conference as well. But first, one word on while we spoke about earnings picking up and he's expecting a 20-25% earnings growth, Uday Kotak very nicely put out this year that this is a year when the micros are good, but the macros are going to be challenging. You have crude at 75, rupee at 70, trade war risk. How are you looking at the risk, factors from the market point of view?
I mean, there are clearly these risks manifesting in substantial slowdown in FII flows in the last fiscal year. In fact, in the first 4 months of this year, FII flows have been negative. However, if you look at the DII flows, in the first 4 months of this year, it has already been $6 billion, which is a run rate of $18 billion, which is similar to the flows that we saw last year, which was also $18 billion.
That is the reason why markets are supportive, right?
Absolutely. So what I'm trying to say is that there are foreigners who are withdrawing from Indian debt, there are foreigners who are withdrawing from Indian equities, because to them, Indian macro is concerning compared to macros elsewhere.
Right.
However, as far as the domestic saver is concerned, he does not have the same flexibility to move between India and the other emerging markets or between emerging markets and developed markets. And I think as far as the micro is concerned, as Mr. Kotak rightly articulated, that's the one which is looking interesting. Corporate earnings are the ones which are looking interesting. And that's the reason why we see flows continuing in equities, and hence, markets unlikely to see any major correction due to the point on macros that you articulated.
Okay. I take your point. For the foreign investor, there are other options. For the Indian investor, probably between asset classes, equity is still a superb option, considering where real estate and gold are. But now, I really want to get to the specifics, especially because it's a favorite sector. ICICI Bank is your preferred pick while playing recovery. But why only ICICI? Okay, you also have BOB. But a corporate lender would also be Axis. Corporate lender is also BOB, and we are seeing signs of strengthening in other sectors, in other corporate lenders as well. So would you increase your basket as you see these banks perform, or are you sticking to these two?
So 2 points you've missed. If you see my model portfolio, there is SBI also, and there is S-Bank also.
Okay.
So there is SBI, ICICI, S-Bank, which are part of my model portfolio. What you are looking at is perhaps the quarterly top idea share.
Yes, yes.
So, as you rightly mentioned, we are seeing a big turn, at least as far as commentary is concerned, on the corporate lenders. I think give a quarter or two here or there, you are seeing a upturn in the corporate asset quality. Obviously, as you've seen the commentaries of most of the banks and numbers, slippages, all of those things put together, if you see the key operational indicators, it seems that worst is behind as far as that part of the bucket is concerned. Secondly, if you see the stock price movement itself over the last 45-50 days, ever since the results started pouring in from corporate banks, you have seen that some shift has happened already in the portfolios from richly valued private retail banks incrementally towards private corporate banks. You have not seen a big bang, shift towards the PSU corporate lenders, which are on the mid-cap side. Okay. So yes, it is possible, but from a longer-term perspective, from a 3-year, 5-year, 10-year point of view, I still think that the value migration potential, which a lot of these private financials offer, that is too huge to be ignored for a 6 months, 12 months tactical shift in the portfolios, which is happening in favor of corporate banks.
Okay. Well, let me come to NBFCs. I do see even in your top 10 you have L&T Finance, but it looks like they're out to grab market share, especially from public sector banks, but not necessarily only. It seems to be generally from the banking sector. Do you see that in the days to come, you will find more of them populating your top 10 or top 30?
See, it has already happened. If you look at the profit pool of my universe, NBFC's profit pool today is 33,000 crores, sorry, 28,000 crores,
okay,
which is almost approaching the consumer profit pool of my universe, which is at 33,000 crores. 5-6 years back, this was unthinkable, right? So as you see the proportion of profit pool rising in favor of NBFCs, secondly, what has also happened is the space has opened up because of the stress in public sector banks. So the opportunity is huge. The size of prize is very big. And a lot of these NBFCs, which have done well over the last 3 years, 4 years, they have a lot of room to still grow.
Okay, so still positive on NBFCs. That's the view from Motilal Oswal. We'll take a quick break.